Good morning, everyone, and welcome to the huge investing long-term trading event today. This event is brought to you by Timing Research and Trade Out Loud. The event is being recorded, and all the recordings will be available as soon as they're processed on the TimingResearch.com website. David Kosmeter and I, Anka Metcalf, will be your host today. So before we begin, let us remind you that all information provided today is for educational purpose only. It should not be construed as investment advice regarding the purchase or sale of securities, options, futures, Forex, or any financial instrument of any kind. Pretty sure you know by now that trading involves a high level of risk and may not be suitable for all investors. You could lose money. Before deciding to trade, you should carefully consider your objectives, your level of experience, and risk appetite. Individual performance depends upon each person's skills and time commitment and definitely effort. Results may not be typical and individual results will vary. You must do your own research and make your own trading decisions. And with us today, we have a fantastic lineup of pro traders that are happy to share strategies, tips, and tricks with you. And we're going to begin with Sid Norris and Jim Kenny. So welcome. You guys have the mic.
Thank you.
Thanks, Anka.
Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus. And today, I'm working hand in hand with Jim, the options professor, and I'm going to show my technical analysis on a number of items. And then he is going to offer up how a person might approach it from an options trading standpoint. And so we're kind of teaming up on this one. And hope by the time we get finished, you'll have some excellent ideas about maybe improving your trading of the markets. Before we get started, I know that we just heard a disclaimer, but I want to give my disclaimer as well. There's my website. It's ElliottWavePlus.com. And you scroll all the way to the bottom of any page and click on this Terms of Service Disclaimer tab. And there's my disclaimer. It's there all the time. So please go there and read that. If I were to summarize it in one sentence, it would be there's risk of loss in all trading. One additional item I'll point out to you that you may want to use after today's presentation is there's that contact us. So if you would like to send me a message or an email, please do so. You can use that right there, or you can email me at sid@elliottwaveplus.com. And I'll just let you know that what I usually do on these presentations is if you're never subscribed to any of my services before and would like half price on your first month, just send me an email or get with me on that contact page, and we'll work out something on the email. First, I'd like to start today with what I think is the most important item to track in the markets today, and that is the US dollar index. It appears to me that the US dollar index is a linchpin at this time for the entire market. And as many of you may know, we've recently seen a strong downdraft in the US dollar index. And from an Elliott Wave perspective, I'm counting that as a 5-wave, complete structure. And anytime in Elliott Wave you have a completed 5-wave structure, you're going to get a retrace. Usually the initial target would be back to the extreme of wave 4 of 1 lesser degree. So that'd put us back to 97.80 on the US dollar index. And I think that that is where the US dollar index is headed between now and the end of the year. And the reason I say that is because of cycle analysis. Here's I use 2 different tools for cycle analysis. One is Sentient Trader software, and it uses the cyclic analysis methodology of J.M. Hurst. And this is a roadmap of the US dollar index using that software, and the software is able to look and analyze data, look at data all the way back through January of 1967. So it's extremely long. It's able to look at the longest cycles running in the markets today. And you can see that this composite line, which is basically a combination of all the cycles that it has been able to deduce are occurring simultaneously in the markets, and it comes up with a general direction next. And so very likely what we just saw at a recent low in the US dollar index was something in Hearst called a 20-week cycle trough, and this composite line suggests upward movement. And I know that there's no date or printing there on what that date is, but that is coming in late in the year. So looking at a rally in the US dollar through late in the year, then another move to the downside that looks like a 5-wave move there, down through about March of next year, and then one more retrace back up into about June, July of next year, and then a real meltdown in the dollar. This could be extremely important if the dollar was going to lose value like that. And I can tell you that it continues to move down through the middle of 2023, the mid 2023. So for between the middle of 2021, middle of 2023, many would call that a projected collapse in the US dollar. But between now and then, the middle of next year, it looks like we're going to get potentially a 1-2-1-2, a very bearish setup in the US dollar. But right now, it's time for up. It's time for up in the dollar. So what does that mean to the rest of the markets? And that's the reason I'm starting with US dollar, because it is extremely meaningful in how it affects the pricing of assets. And that would include stocks, certainly commodities, and I would say most heavily commodities, but it's likely to have an influence on stocks as well. And if the dollar's moving up, those items are likely to be weak. So that is kind of the overall message that the US dollar index is projecting, is that we're going to see weakness in commodities and stocks between now and late in the year. And then looking in at a daily chart, you can see that 5-wave down structure there. And now it really is starting to get going a bit to the upside. It's looks like it's about ready to take out the end of this last peak, which I think was the end of a wave 4. And I think it's headed higher up into late October next. A little pullback into mid-November, and really just generally moving higher up and through the end of the year. So, Jim,
yeah,
if you were going to offer up, and this is I would call this a fairly high confidence roadmap that we're going to get a stronger dollar here after a very clear 5-wave structure, probably back to the wave 4 of one lesser degree. So what would you do about trading that?
Yeah, and again, everything that I talk about today is just my opinion and my observation, certainly not a recommendation, because you have to go to your brokerage firm and yourself to determine what's suitable, what's not. So here we go. I'm going to give you some of my opinions here. As far as the US dollar is concerned, like Sid was saying, it seemed to peak out in March, and it's dropped about 11% to the low we recently saw. That's probably not coincidental that we saw commodities have a good time and the stock market have a good time. So that's basically what Sid was saying, is that US dollar move coincided with a significant move in the markets, and also it may in the future. So now we're bouncing off of this low area with some targets that are above the market. And so there are different ways of going, as far as some are more aggressive from their price target and some are less aggressive. I'll go over them right now. So right now we're at 93 and change. So a call spread where you buy one call and sell another, the call spread of buy the 93 call, sell the 94 call. And by the way, these are all prices from Friday. So obviously they're going to be quite different with the volatility, but you'll get the idea. 93-94 spread was going for about $390. If you could be above 94 in the December expiration time frame, the maximum on that spread would be 1,000. So 390 to 1,000 maximum gain. Maximum risk would be the 390. 94 call buy, 95 call sell, $260 with a potential of maximum 1,000. Next one up is 95 call, buying and selling the 96 call. That's only $170 with a maximum gain of 1,000. So there's some pretty good risk rewards there if in fact we're going to get that rally and that bounce back. If you want to have an unencumbered call, meaning no sell against it, which means you have unlimited gain to the upside, not a capped gain, I would look towards the 95 call, which was going for about $500. If we went to 96, it could be worth 1,000. If it goes to 97, 2,000, 98, 3, or if we hit that 99 upper parameter, the $500 would have a potential of going to 4,000. So that's an 8-to-1 risk reward if we got the higher end of the target. So these are limited risk strategies with significant upside if in fact we got the move, and each strategy has a lower top to it. In fact, the 95 has no top to it, meaning that you can be as aggressive for your target price or less aggressive based on the strike prices you choose.
Oh, that's great, Jim. Hey, let me ask you, do you take into consideration whether the options are extremely expensive right now when you decide which? In other words, how do you decide if they're too expensive to participate, or does that come into your thinking at all?
Well, if you have a lower target, like on the first one, 93, 94, we have a fairly low target there. And so those premiums are going to be a little bit larger. But overall, the dollar index implied volatility is quite low compared to stock options for sure. And so that's why you could do an outright call at 95 for $500 and have a pretty good upside potential. In fact, you could probably do the 94 calls for a reasonable price as well. So if you didn't want to do a spread where you're capping your gain at the difference between the two strike prices, you could just go out and buy a call at 94, 95 and see if you get a big bang. And if you do, obviously, there's nothing holding you back because, you might be saying it could go to 97, 98, but, you don't know exactly where it's going. So it could give you a nice upside. But yeah, by definition, the dollar index right now would be considered lower premium.
That's what I was thinking. Is this might be kind of an easier trade, a less expensive, less risky trade than some other items that have extremely high implied volatility at this time.
Yeah, you're not going to get a 1 or 1.5 point out of the money call option for $500 on many markets right now.
Yeah. Okay. Let's move to something that really is it's probably more popular tradable item, and that is the euro. And the euro should move generally opposite the U.S. dollar index. And my roadmap is going to look pretty much exactly opposite, is that we're going to see downward movement in the euro through late in the year. And that if my wave count is correct, we're just now getting ready to break down in a wave 3, and that's where you get some of the most aggressive action in Elliott Wave is during wave 3s. So Jim, if you were going to trade this item, what maybe we would have different levels here. Obviously, yes. If you were going to go naked on it, you would just buy puts. Right. But what are the other possibilities here?
Well, again, as I did with the dollar index, I did some spreads. And again, a spread is where you're going to buy one option and sell another. And the differential in the two premiums is going to be your maximum risk. And then your maximum reward is the difference between the two striking prices. So right now you're looking at the 118 ballpark area, a little lower than that today. On Friday, looking at the euro, I was looking at a 118, 117 put spread, was going for only $500. Again, the premiums are fairly low here, and the differential there is worth $1,250. Every point is $1,250 as far as full 100 points. So 500 to 1250, 118, 117 put spread. You lower it, you go to 117, 116, you go for 330. And again, 1250 is the maximum gain if you go to 116 or less, and all the time premium comes out of both options. And then, of course, if you want to go with a bigger window, you could buy a 117 put, sell the 115, and that's going for 687, but it has a potential of 2,500. So, 10 of those at 6,870 to go to 25,000 is certainly sounds like a pretty reasonable risk reward if you're correct. If you just wanted to buy an outright, where's the lower end of the target? Around 114?
Eventually, when we get down into November, if that's what you're talking about
right.
1.115, somewhere in there.
Well, I mean, if you got that kind of a move, obviously just buying an outright put at 117 would be $1,362. And at 111, you'd be 6 points, providing it was at 111 and all the time premium had come out of both options. That's when the spread would go to the full 6. And 6 times 1,250 means you'd have a potential of 7,500 on every $1,362 you risked using a 111 target and all the time premium coming out of both options. So the risk reward here is substantial. There's no doubt about that.
So let's say you just wanted to short this thing going down to maybe 114 for this initial leg down into early October. So what expiry, and let's say you wanted to just buy put.
Well, these are December options. So obviously, if somebody had a question, what are the Novembers going for? You just change your month. They should be cheaper, obviously, because they have less time on them, the strike prices.
Yeah.
But of course you have less time. So if your compass is wrong by a month, you'd be expired, where the guy in December would still be alive and well.
Right. So do you like to give a couple of months, look out a couple of months from the target date and spend a little bit more money and give yourself a little bit more time, or is 1 month enough?
Well, like I say, it's all about aggressiveness. My rule of thumb would be, obviously you buy time when you're buying the options, and you short the nearbys because you want the Black-Scholes time decay to work in your benefit. If you're pinpointing and you want to be very aggressive, clearly more aggressive, if you're correct, is more money. So if you do shorter term options and use them for this, you can take these numbers down that I'm giving you as far as the prices are concerned, because the premiums would be much less, and you could increase the returns because obviously if you get the movement before and you're in the right month. But I personally think measure twice, cut once, give it a little bit more room.
Yeah. Okay.
And so I think these would not be as great a gain as you would if you bought only the 1 or 2 months. But if your compass is wrong, they take the rake and all the money comes off the table.
Yeah, and you're just essentially controlling your risk.
In other words, if you were incorrect, you may have a possibility of capturing some of the premium that you had paid and come out with some money. If you're wrong on a short-term option and the time runs out and the price has gone against you, those things go down to zero pretty fast, and so you're basically done.
Yes, very good. Let's move to the U.S. stock indices. We'll go to the S&P. Okay. By the way, I'll show this very short-term chart before we move on, but it does appear to me on the ES contract and on the NQ contract, and it's even more obvious on the NQ contract, and this is important in the Elliott Wave world, is that from the top tick that we saw on Wednesday of last week on these items, there does appear to be a 1, 2, 3, 4, 5 wave structure, pretty clean. And that is something Elliotticians look for because the top in the stock markets because everything was moving almost unidirectional up into that top, that is unlikely to be a C wave of an expanded flat, and it's much more likely to be a trend change, in my opinion. And after a 5-wave structure, you would get a corrective period, and then you would get at least one more 5-wave down structure that's typically at least as big as the one you just saw. And so that is a relatively bearish outlook, but after the 5-wave down structure through Friday, we got 3 waves up for wave A, and I think this is 3 waves down for a B wave. And I think the market is going to rally here next back to the wave 4 of 1 lesser degree. That is at 34.84. And that might take a day or two to happen. And so I don't think it's if you're wanting to time this thing just right on the money, I don't think this is just going to continue unabated straight on down. I think it's going to have one last move that it's going to put in to the upside before there's in other words, I'm saying it might be a little late to chase this thing right on a very short-term trade. You might want to look for a pullback to 34.84 before attempting something on the downside. And this happens to be a trading template that I use, where I combine a bunch of stuff, the ADX indicator, the AMA, adaptive moving average indicator, different settings for buy signals on using MACD line crossovers, and different settings for sell signals. It's a little quicker to buy, a little slower to sell, because the stock market generally is skewed to the upside. And so this is kind of a new template I've been working out that I'll probably do something more with for subscribers moving forward. But just to get to the longer term S&P, this is a weekly chart. I think the entire period from January of 2018 through March of 2020 was a massive expanding triangle. It's a very rare, or megaphone pattern. It's a very rare pattern in Elliott Wave. There's only been 2 or 3 of them in the entire history of the stock market. And then this really aggressive ramp we've seen since the March low, I'm counting as a 5-wave structure, complete. And that could be the end of a 5th wave. And so what we just saw last week is in my main count, is that we've just seen the end of 5 waves up from the 2009 low, and also the end of 5 waves up from the first quarter of 2016 low. So that would be a 5th wave. So we could easily be getting into a bear market here. The alternate is that we'll get this pullback that I'm calling for down into November, and then the market is going to put in more all-time highs, topping sometime next year or the year after. Most of my cyclic analysis is not suggesting that that's the way this is going to go. So this is a rather bearish situation. I do have a bullish alternate count, but in both counts, it's more immediately, at least on the intermediate term, bearish. And that would, so cycle analysis is calling for a move down into November, December timeframe on the S&P. One of the other cycle tools that I use, I just showed you the Sentient Trader cycle tool. Here's another cycle tool I use at the Foundation for Study of the Study of Cycles. Foundation for the Study of Cycles. It costs $100 a year to join, and if you join, you have access to this very valuable tool that you can run your own cyclic analysis, at least on short-term charts. By short-term, let's say intermediate-term charts on just about anything in the markets, including cryptos and everything else. And this is analysis of the Nasdaq Composite. And you can see that based on cycles analysis, and this pink line is called the Composite Line, and this particular program is different from Hearst. It pinpoints what cycles are the strongest in the market and that seem to be recurring over and over with relative accuracy. And the very strongest one in the market right now is a 171-day cycle. And if we look just at that dominant cycle, it was expecting a peak. That's dominant cycle is shown down below. It was expecting a peak in mid-August and then a move down into mid-November. But when I add the other strong cycles to the mix, it gives a little bit more character to the composite line. As you can see, this this cycle analysis has been bearish since August 25. So the market did stay up for one full week, and it continued to shoot up for one full week after the projected kind of most likely topping zone or date zone for the cycle. And we found out recently what may have caused that. There was an attempt to manipulate the markets by SoftBank, but that appears to be, and these attempts to manipulate the market go back in history, been attempted many times, and usually have a short-term effect on the markets, but they don't have the ability to just completely override and take control of the markets on an intermediate term. Now, unless we're talking about the Fed and some sort of monthly program to systematically manipulate the markets, and those sort of things do have an effect as well. But you'd be surprised that Elliott Wave analysis and cycle analysis still have a place in the markets, even with these super aggressive attempts at manipulating the markets in place. So the recent high we saw in the Nasdaq and the S&P was accompanied by some of the most extreme one-sided measures of put-to-call ratio, advanced decline ratio, sentiment in both in retail and commercials. It really kind of set records and we've seen some amazing extremes before at the Y2K top, 2007 top. The top in January of 2018 had some extreme readings, but none of them, the 1929 top, the 1966 top, none of them were any more extreme than the one we just saw. And most of those tops were followed by crashes. So beware. You know, they can attempt to try to keep this thing up, but the Fed's been around for 100 years and there's been plenty of crashes. And so they can't stop everyone. They might be able to soften the blow. But you know, if you listen to the financial media, they would claim that they're in full control all the time of markets, and that just simply isn't correct. They don't have that kind of power. They can nudge it, but they don't have that ultimate control. And so you can see that this composite line is expecting a general downward movement down into mid-October, a little sideways movement through the middle of November, and then a bottom over in December. Here's another real interesting thing about this composite line, in my opinion. Down through mid-October, and then a ramp up into the election date, November 4. And then what this downward action after the election down into December kind of indicates to me is we're probably not going to know who won the election for several weeks after the election. It's kind of interesting, the projection to make, and until we maybe get to pretty late in the year. So there's another cycle analysis tool that I use, two different cycle analysis tool in addition to Elliott Wave. And so getting back to the S&P, we'll move to the structure on the way up here. I'm counting as a finished 5-wave structure. I do have an alternate that allows the market to make one more slight new high above the high we saw last week. Yeah, there is a Fibonacci target on the S&P up at 37.29 that hasn't been hit yet, and that is where wave 5 blue would be an extended equality with the net travel to 1 through 3 blue. So, but we did get into some extreme overbought behavior. There is some unwinding of positions that are likely going to affect the markets on the short term. Here's the 240 minute. So I'm expecting a bit of a rebound after this 5-wave down structure. I'm expecting a bit of a rebound. And now moving to the very short term chart, it looks like we are getting kind of a double bottom here in the last couple of days. So this I'm not exactly as totally confident in as I am in the general move of the on the US dollar to the upside, probably because of how much manipulation we've seen. But I would say we're looking for a finish of a corrective structure back to 34.84 and then more downside. It may take several days for this to move sideways and digest what just happened to it before it starts moving lower. It could take all the way to the middle of September, according to my cycle tools. So, Jim?
Yeah, based on what you're saying there, I was well, I have a December. Some of the things I took off the screen from Friday are irrelevant because I was working with the September contracts, and the puts have already exploded with this kind of a move to the downside.
Yeah.
So rather than going over trades that would have been lovely to have on Friday, let's talk about right now a little bit. And right now, I would, based on what we're talking about, a longer term put spread into December, something like a 3270 put long and a 3200 short, which comes to about 21 points, would give you an opportunity to make as much as 70 points, or the spread could go to 70 from 21, if we got down to 3200 by the expiration of December. And the time premium came out of both options. And that's a 10% drop from the high of 35.80, but only about a 4.5% drop from the lows today. So it's not a tremendously large move to get down towards 3,200. But so that would be the base situation, because you think the forecast or the opinion is that we are going to be having a more substantial drop in October and November. So that would encompass that time, 3270 put versus these 3200 for 21 bucks. And that's what it's going for today. If you got the rally, that spread obviously would go, that the premium would go down. It would be cheaper to get involved in, or you could raise your strike prices. So those are two things you can do. Now, if we are going to have a short-term bounce, it wouldn't be a bad idea to maybe look at the September options that have 2 weeks to go as a bit of a hedge, and to see if you could take advantage of the bounce from here. We're at around 3360 ballpark. And so if we were to go back towards 3470, let's say, you could buy something in the area of 34. Let's get an idea here. Yeah, say you get something in the area of 3420, which would cost about 92 points now. And then you sold something against it like 3260, and that's going for about 24. And so the differential there is about 68 points. And then, yeah. And that, one thing to note about the options on the S&P right now is they are the direct opposite of the dollar index, meaning the premiums are fantastically large. And also the bid offers are going to be pretty large. So some of the option trading in the S&P right now is more difficult because of the volatile nature that the market is. Again, it's best to put on these positions when the markets are more orderly, and obviously when the markets don't have the highest premiums, because sometimes buying one, selling another during certain environments like this can be very difficult because the pricing is all over the place. So, but again, if the base case is that we're going to get a rally and then drop, rather than, fooling around with the bounce, maybe just think about, the main thing, which is that we're going to have another decline. And so looking at the strike prices, like I mentioned, 3270, 3200, $20 in, $70 out if it goes to fruition. That's not a bad one to look at, but maybe don't put it on until you see if this rally occurs, and then after this rally kind of peters out. You were looking maybe for something up towards 3,400, 50 or higher, something like that. So obviously you could either look at this spread at a much lower price, 3270, 3200, or you can raise your strikes to maybe 3350, 3275, and then price out the spread there. But the bottom line is right now, with the volatility and the premiums being so large and the bid offers being all over the place, this is kind of like getting involved in a blizzard, and it's probably better sometimes just to stay at home until things settle down.
I would agree with that. The VIX is up in the high 30s here now.
Mm-hmm.
And so premiums on options are going to be extremely expensive. But I don't know if it's worth trying to make money on the long side here either. It's kind of dangerous. And so I think waiting it seems to me to be a good idea, and see what develops next. If this wave count is correct, we'll get a 5-wave up structure on a 30-minute chart, and it could take several days. 5-wave up structure back up to, possibly all the way back to 3,500. So we'll see how that shakes out. Let's take a quick look at the Nasdaq. It's in a real similar position. I know you prepared to talk about a lot of individual stocks, but I think the individual stocks that you were talking that we talked about yesterday on the phone, Jim, were a lot of them were the high flyers,
right?
And I think that those we may be seeing a rotation out of those. I'm talking about the Teslas, the FANG stocks, basically.
Mm-hmm.
And we may see a rotation out of those stocks. And so those, I think, are some of the most interesting shorting possibilities in the stock market right now, because they had just screamed so aggressively to the upside, to extremes. And I can show you a couple of ways that I measure that. But as far as a wave count, yeah, I think we've seen a significant large cycle top last week, and we're going to see that same move. And that's the reason I started with the US dollar index, is I was looking for a dip down into November, December in anything that's priced in dollars, because the dollar, I think, is going to go up. And so here we have the Nasdaq, and I think we have finished a 5-wave down structure here as well and I'll show that in a second, and looking for a rebound before it continues lower. Here's that same template I used. So there's the top that occurred on Wednesday of last week, and you can see you have a more prominent wave 1 and 2, 3, 4, 5. That really looks clean, amazingly clean. A lot of times the first leg down isn't that clean, and it shows how much emotion was pent up in the markets. A lot of times Elliott Wave, the more emotion there is in an item, the more clearly you can see the waves in Elliott Wave. And then this move up in 3 waves, move down in 3 waves, potentially a double, kind of a double bottom. And so what I'm really looking for is a flat, what is called a flat, and a move back to 11,843 before it turns back south. And as far as how long that takes, I know I'm drawing it where that would happen through tomorrow. So and then I already showed you how very bearish the roadmap is, the cyclic roadmap using the CSC program. So we're kind of in the same dilemma right here as we are in the NASDAQ, or in the S&P. But I think there would be a rotation out of these names and into value. Would you agree with that, Jim?
I just think the people on the sideline and people who are getting whacked in the NASDAQ are going to want to go to something that they can make a rational story about. And that's where the PE ratios are 14 or 15.
Yeah.
And that's where they pay a dividend. And that's going to be very, very attractive to people who are either getting whacked in the NASDAQ right now to rotate over into something like that, or the sideline cash who's getting very tired of zero money market. They're not going to want to get into something that they could just see they would have lost 40% or 30% or 20% in 2 days. That's why they're on the sideline. They don't want that kind of risk. So the bottom line is that the lower PEs and the value and the income creating stocks certainly would be, I think, the future.
Yes. So, and I think that that attempt to rotate will occur this month, but I think it'll be met with disappointment as well. I
Mhm.
just don't think stocks as general are, I think they're just way too high, and we're looking for this pullback into November, December for, then I think there's quite potentially some excellent buying opportunities there.
Mhm.
But in the meantime, as far as I can tell, uh, we're moving to the downside generally. And this
Yep.
five wave structure that I'm seeing as a kickoff move is very telling from an Elliott Wave standpoint.
Can I just interject one thing here, Sid?
Yeah.
Your work has been outstanding here in that you have been talking about a major turning point happening in this time frame. And so I've agreed with that as well. So as far as option strategies are concerned, sometimes it's best to have a plan before it happens. And that's one thing good about using your research or having some plan you get from other sources. And that if you thought the market was high at 3580 on the S&P and 12,000 on the Nasdaq, what I was saying in my newsletter is really what I would tell you to do, which is do your defensive tactics up there, which is sell some calls, fat calls on Tesla and Apple. And then after you sell the calls, you can either just keep the premium or you can take the premium on the call and buy puts underneath. A good example would be, say, Tesla at 500. You sell the 520 call and you take the premium and you buy the 480 put. Now you've got a parameter on Tesla where you could make up to 520 if it goes, but your risk is limited with the put at the 480 level. And now we're at 362, and everything under 480 you've been protected from. So the selling of the calls up there, the doing the collar that I just mentioned, or even just trimming, or a married put. I mean, if you made 400 points on a stock, I mean, for God's sake, throw 10 bucks into insuring it. So up there, that's what you should be doing, which is what I brought to people's attention. And again, you've been kind of bringing them that is the environment. And then if we get this big drop, then you start thinking about what? How fat are the put premiums going to be? So you make your list of stocks you love, and you look at the out of the money puts, and you sell the out of the money put. For instance, say you like Tesla and it's at 362, and we drop to something like 300 or 250 or whatever, and you can see the 250 puts are going for 50. Well, if you sell the 250 put for 50, you're actually trying to buy the stock at 250 minus the 50 bucks or 200 bucks. Can you sleep with that? Then you could sell the put there. And same thing with Microsoft, Google, Amazon, and all the other great companies out there that you might like. So when the market does go into the tank, be ready with your put selling strategy. And one other thing to do when the market is down hard and the VIX is way up is you can sell puts and buy calls with the premium. In that case, just to give you an idea, let's say Tesla's at 362 and it drops hard down to 300. And you sell the 250 puts for what we just said, 50 points. And then you take that 50 points and you buy the calls, up at 350 using the premium from the 250. So now you've got long at 350 and you're basically trying to buy it at 250. And ergo, if you get put to stock, you'll have to put up to 250, but you'll still have the calls at 350. And if the stock really goes down and then way back up to 400, you could actually make it on both sides. So, the same way you sell a call and buy puts when you're way down, you sell the puts and either just do that, or you can sell the puts and use the premium to buy calls. These are the strategies you want to have in your pocket before the movement. Days like today, you should just really be reaping the rewards of strategies you put on at the right time.
I see a question coming in on the chat, Jim. Question is, can you do options on Forex?
Absolutely.
Yeah. Would you do that on the futures contracts?
Yeah, generally, I think the liquidity is better on that, but I couldn't say 100%. But yeah, I would say that the futures contracts would be the place that many people go.
Yeah, so like the futures contracts on the euro, the ticker symbol is going to likely be something like 6E, and then if you look at that futures contract, on your platform, and then you'll be able to bring up option chains on that.
And of course,
So
if you have any questions, your provider could also help you with that.
yeah. So do you want to do anything else? Almost all of these roadmaps that I've got on these high flyer stocks is relatively bearish, but we probably have this initial washout about done. You can see that it's creating a little doji down here, and I do think we'll get a bit of a pullback before these things continue aggressively lower. But the amount of extreme overbought on these names. I'll just show you very quickly on my trend following algo. And this, I show these trend charts every day as part of my free to anyone that's subscribed to my blog. I show the trend charts on the FANG stocks. And you see that brown box right there? That means that the ADX indicator has moved above 60. And anytime the ADX is above 60, you're very likely in unsustainable territory. That is an extreme overbought or oversold territory. For instance, you look at the same chart template on Boeing. You remember that it got mashed real hard down into that March low. As a matter of fact, Boeing went from $350 a share down to 89 in just a matter of about a month. And you could see how extreme the ADX was at that low. But most of the extreme readings in the ADX came in on these FANG stocks very recently at the highs. And that's another really troubling sign. It's just not, I don't think, a good idea to keep buying these stocks. Not with the ADX way up there. There's got to be a bigger pullback and a more extended pullback than what we have seen so far before I think we see the next buying opportunity.
I just want to interject because you had the Apple up there. Just today, and again, the base case is not that we are at the lows on these things, but just Apple, for instance, a put option. Going to December at 100 is going for about 550. Let's call it $6. And that would mean if you sold the put at 100 on Apple, you're agreeing to buy it at 100 minus the 6 or 94. And basically, that is obviously those numbers would be much larger if you got Apple going from 116 down to 100. But again, when you're selling a put, you're agreeing to buy the stock at the strike price less the premium. So you have to be willing to actually buy the stock, and your risk will be the strike price minus the premium. So again, some of these premiums, right now the 110 is going for just under $10. So if you got it at $10, 110 minus 10, you're actually buying it for 100. So if the VIX, if the market does drop sharply, and the VIX does do a big jump, looking to the put selling is not a terrible idea. And then maybe you would start out by selling the put where you know exactly you're agreeing to buy the stock less the premium. And then if you start seeing a turn, since you have that extra money from the premium, you could speculate with that. It would just bring your break even. In other words, if you sold an option for 10 on a 110 put and you spent the premium, then you're agreeing to buy it at 110 with no help. So again, take advantage of the VIX and the volatility, because when the volatility gets crazy, the premiums get crazy, meaning high. And again, you're allowed to write them as long as you're willing and have the money to buy the stock, because that's what you're doing when you sell puts. You're agreeing to buy the stock. So you have to have the money to do that. And
right.
you have to understand if it gets under your cost basis, obviously that's where the risk is.
Now, I will say on Apple, as far as a target for the downside, maybe as we get into November. I think 89 is a good
Mm-hmm.
target. There's
Mm-hmm.
a 1, 2, 3, 4, 5 wave structure with kind of a blowout fifth wave.
Mm-hmm.
And in Elliott Wave, what is most likely is it will return back to the extreme of wave 4, one lesser degree. That's at 89.15, and then bounce. Probably a good 0.618, retrace back up to maybe 120. So there might be an opportunity down around 90 to catch Apple back up to 120. So
yeah, if you price out the option, Sid, and you sold something in the 90 area or the 85 area on that big drop,
yeah.
and then took the premium and bought yourself a 105 call, you could, if it went to 120, you could make $15 on the premium that you just took in underneath.
Yeah, awesome.
Mm-hmm.
What do you want to go to next? We've only got 12 more minutes.
Well, do you want to take a look at crude oil? Do you watch that
Sure.
at all?
Yeah, I watch everything.
Let's try to get gold and crude in here and then close it up.
Okay. Crude oil's been an odd animal lately because, well, obviously, on the short contract it dropped below zero. First time that's ever happened back in April. Now the futures contract had already rolled to the next futures contract, so officially barrel of oil got down to $6.50 in April, and then you can see that I think it moved up pretty aggressively through about early June. And then it's been kind of just grinding in what I have turned the term I've coined is caterpillar pattern, where it's just like an inchworm. It's the volatility really came out of crude oil until just recently, and now we're seeing this smackdown. And I just said on my webinar for subscribers for Pro Plan subscribers at my site on Sunday that I expected it to move down pretty aggressively now, but find a bottom around 33.63, and then we could get a bounce that would last maybe a month or two. So there's my roadmap. I think it kind of pukes out to 33.63 pretty quickly, and then that could be the end of a fourth wave, and we have a fifth wave up, and sometimes fifth waves up in commodities can be pretty aggressive. So that's my main count. It's been hard to be confident in anything because it spent 3 months in this caterpillar pattern, but now it's finally kind of breaking loose. I think there's a near-term low of 33.63 and then a bounce.
The the December call spreads, if we were going to get a bounce, and of course it's got more to go on the downside. Where are we today? About 35 or 36?
36.33.
Yeah. So obviously you wouldn't do this today necessarily because you're thinking it could be dropping a little bit further. But if there was a move back to 40, right now the 38 calls are going for about 3, and the 40 calls are going for about 2. So basically you're putting up about 1 to make 2 right now. And obviously if we went down lower, you could either lower the strike prices to say 35, 37, or you could keep this one here and maybe, pay half price 500, and then 500 going to $2,000. If we got to 40 or better and the time premium came out of both options, that's not a bad risk reward. So, and going back to 40, maybe wouldn't be off the table if things really reversed like you're talking it could.
Yeah, and one other thing associated with crude oil I would show would be the XLE, which is large cap oil
right.
ETF.
Right.
And, I do these Hearst cycle and cyclic analysis and look for turns in particular date ranges. And let me get to XLE. And I think XLE here pretty soon, we're going to get a bounce that'll last about a month. And so this roadmap is in agreement with the crude oil roadmap.
And what would be your target on the bounce back?
I think it's still in a corrective phase. I think we'll get a bounce into, let's say, early October before a plunge, the final plunge down into late November. And then I think crude oil and anything related to crude oil is a screaming buy.
Mm-hmm.
But I would say if this item bottomed today, then this would be a wave A, and this would be wave B of a flat, and the target would be 41.95. I'm not sure it's bottomed yet, though.
Mm-hmm. But do you think it could go back towards the 41 area?
Yes.
Yeah. So basically, if you go to March of next year, why would you go to March of next year? Because based on the forecast, you're going to need some more time besides just December, because the thing's only going to be near a low point in the November, December timeframe. So if you went out to Q1 of 2021 and you look right now at the calls, say at 36, they're going for $2.69. If we go down to your numbers, you could either drop your strike price or this call would probably drop substantially. And if it dropped down towards 1.5, and you say we could go back towards 40?
Well, if it bottomed today back to 42,
Yeah,
but
so
yeah.
it went to 42 and you picked this thing up for $1.50. 42 is going to be $6 to the upside. And if this premium drops because there's another drop in crude, the premium dropped towards 1.5. That might be a heck of a decent time to take a look at that one. And you'd be good until the March options expire, which gives you some time after the November low area to see a rebound. So that would be a strike price I'd probably keep an eye on. Not at this price today, but at a price that would depreciate with a further drop. And then, of course, buy yourself some time while things are cheap, and then you can sit on them and see if you can get the move back up.
Yeah, I think you'd want to see some kind of proof that
Yeah.
you're getting a trend change. I mean, right at the moment, things are negative
Mm-hmm.
here. But I'm expecting a potential bottom in oil within a couple of days. Now, I can see a lot of interest in these stocks because they've been beat down and they pay a dividend.
Mm-hmm.
And the possible rotation into this kind of stock out of the high-flying, FANG stocks.
Yeah, this is part of the story of give me low PE, give me dividends, and give me something that is in the recovery story. When these planes get flying again, jet fuel is going to go up as far as the demand. When people are unencumbered with the mass and the concerns, that should be a very good demand shock. And the rig counts and the fracking business has been damaged, so the supply should be somewhat under control, and that would be a recipe for maybe a rebound.
And then moving on to gold to finish up here, we only have 5 more minutes, is I'm generally bearish on gold, and the reason is because I'm bullish on the U.S. dollar. It's that simple. And if you'll recall, the roadmap on the U.S. dollar was that we would get an ABC to the upside in the US dollar. And so you can see that this roadmap is exactly opposite of the US dollar index. And I think that is generally the way gold is going to roll. Some people think that, the stock market is we're calling for a crash in the stock market or something, better buy gold. That correlation doesn't actually exist in history that way. Sometimes gold acts like a safe haven, but most of the time it is a hedge against inflation, and it moves opposite the US dollar. And while the US dollar was puking out recently, the gold obviously moving up, but then gold topped and it's looking rather weak right here, and I think it's going to move down through late September, then rebound through late October, and then bottom late in the year. And a potential major buying opportunity in gold coming late in the year around 1680. But until then, a corrective ABC structure is my best roadmap.
Yeah, on the GLD, which is what do you call it? A ETF people use for the gold. It's trading about 180 right now, right?
I don't know.
Yeah, we're around 180. So basically, if it went down towards the 160 area or 165, just a put spread on the gold. 170 puts are going for 374. You just buy them outright, 374. You go down towards 160, 374 can go to 10. And or you could do a spread, buying a 175 put, selling a 165 put. And again, that goes for a couple of bucks. If we went down towards 165 by December expiration, that $2 can go to $10. So that would be something to try to take advantage of a decline in gold between now and the end of the year.
Hey guys, sorry to cut you off. We're only a few seconds away from the top of the hour, so
Okay.
if want to do just a quick closing statement, then
Sure.
I hope everyone enjoyed today's presentation where we team up and show roadmaps that are derived through a pure technical analysis and different ways to potentially trade those in the options market. Jim, I really appreciate your input. I'd like to do this again with you in the future.
Sure. And for those wanting to know more about options or get a free weekly market update on everything from the stock market to the metals and everything else, basically you go to optionprofessor.com and stick in your email and you get a weekly update. And basically that's how we handle that. There's a lot of different angles on how to work these options, and I've been doing it for decades, so I'm more than happy to share my knowledge and experience with you guys. So just go to the website. And Sid, do you want to make sure people know how to get a hold of you? Because obviously having the idea of where the general trends are going to be happening, combining it with options is a good idea.
Yes, just simply go to my site, ElliottWavePlus.com, scroll to the bottom, and send me an email right here, and we can start communicating. I can get you a half price on your first month on any of the levels of service that I have. Just send me an email and let me know you're interested in that.